Hello, my name is Rodney DeGabriele and I'm the Principal Advisor and Managing Director of Affinity Private. So I'm here today to welcome back to the Affinity Private office Michael Karagianis, who heads up Private Investment Consulting, to talk to us today about market insights. Michael, how are you?
Very good, thank you, Rodney.
That's good. So thank you so much for coming in again. So, couple of questions about the market, locally and globally. So, what do you see as the major drivers for market performance over the next coming 12 months or so?
Well, I think looking at the positives and negatives, on the positive side, global growth is quite robust. We've got most major economies actually synchronised, growing at this point in time, which is the first time since the global financial crisis, really. We've got low inflation and no signs at this point of an inflation breakout, so interest rates remain very low. So those are the real positives, and they're quite significant. On the negative, however, the things we've got to be careful of are that markets have probably, to a large extent, already factored that into pricing. So valuations for many share markets are already pretty stretched and have reflected a good economic environment. And of course, we have geopolitical risk that is increasing and by its nature is quite uncertain. And I guess, from a corollary of that is that, we anticipate that over the course of the next year or so, you could actually see more volatility within markets than what we've experienced over the course of the last few years. Markets perhaps struggling to make the same sort of gains that we've seen recently, but also potentially hit by more periodic downdrafts. And from that point of view, I guess risk needs to be part of the investor psyche moving forward over the next 12 months.
Right. So, having said that, how should we be investing clients' money for uncertainty?
Uncertainty by its nature means that it's very difficult to pinpoint an asset class and suggest that you go into it. So, often you could talk about potentially, fleeing to very defensive assets like cash, gold, for example. If you're extremely confident of very negative market environments, that would be perhaps a safe haven investment. But given that we are uncertain about the environment, there are positives and negatives, we can't afford to get too defensive. The returns from cash are not particularly positive at this point in time. So really the best way of dealing with uncertainty is to actually diversify portfolios as much as possible. And that means having a wide range of asset class exposure, including share markets, global and domestic, bonds of varying types, cash, as well as alternative asset classes that maybe have different types of return dimensions associated with them. And at any point in time, therefore, almost irrespective of the market environment, something is doing relatively well, something might be dragging the portfolio, but overall, you're getting a reasonable outcome and you're getting reasonable stability.
So, characteristically, alternative assets are not correlated to the equities market. Is that correct?
Well, it depends on what you mean. If we talk about alternatives such as gold, then quite often you find that gold can do quite well in an environment where equity markets are actually falling. But we do have to be careful because there are some alternative asset classes that historically maybe have been a little bit too correlated to equity markets. So you really need to be very aware of what you're investing in and get good advice effectively going into that space.
Okay. Now, President Trump has been in power for now 12 months, okay, close to 12 months. So what do you see as, what's the outcome of the Trump trade?
Well, I mean, if anyone can forecast what President Trump's going to be doing in 2 years' time, let alone in the next few minutes, please let me know. But I think the concern that we have is that there has been a very positive market response to the election of Trump, and that was based on the perception of tax cuts, it was based on the perception of infrastructure spending.
Yes.
And none of that really has transpired at this point in time. And if anything, Trump has gotten bogged down in his legislative agenda. He's struggled to get anything through Congress. So the danger is that markets lose patience with this, and this positive Trump trade that people have referred to that has helped elevate markets actually at some point starts to unwind. And that's what I talked about before in terms of the geopolitical risk There's certain global dimensions to that, but there is undoubtedly a US-centric dimension to it as well.
Okay. Now on to the Australian economy. So what do you see, or how do you see the Australian economy performing over the next 12 months or so? Because it's been a rather flat 9 or so months.
Yeah.
So,
look, it's been a mediocre type performance. I sort of characterise the Australian economy now in its sort of 25th year of expansion without a recession. That comes with a cost, and I think the economy is looking very aged. It's looking very tired. We've had the mining boom. The mining boom's passed, and it's now obviously causing a bit of a drag in certain economies like Perth, Western Australia and Queensland. You've got the building construction, residential construction cycle that has really stretched, I think, the economic expansion, but is looking very tired and very exposed at this point in time. So when we look at the economy, we're trying to ascertain what the growth drivers will be over the course of the next year or so. I think there will be areas of positiveness, related to maybe the fall in the Aussie dollar over the last few years. So the export markets are doing better than they have for some time, and that includes agriculture. It includes areas like, for example, education services. So that's a positive news story. But I think that the core of the economy, construction, particularly around residential property and consumption associated with the household sector, is going to be very constrained. And one thing we're particularly concerned about is just the sheer level of household debt that has been rung up in a low interest rate environment. In an environment where the Reserve Bank is probably not going to cut interest rates again, and if anything, what we've seen is a tightening of credit conditions, banks being forced to be more stringent in terms of their lending policies, particularly into the investor market.
Well, that's already started 3 months ago, 4 months ago.
It is, but the wash through of that into the economy more broadly, I think, is still in front of us. And at the same time, very sluggish, constrained wages growth, which is affecting people's ability to service debt. Then I think that prognosis suggests that it's more of the same. It's a mediocre economic environment that potentially at some stage is exposed to maybe a recession of some form. Maybe not in the next year, but certainly over the course of the next 2 to 3 years, it's a risk.
So potentially it could be on the horizon.
Yeah, I think so. We're certainly overdue for it.
Yes, we are. Okay, Michael, thank you very much for your market insights, and I look forward to seeing you all soon.